Hello everyone, and welcome back to Dr. Tao's Quant Lab. In our last lecture, we covered the highly contrarian mechanics of left side trading, buying into an active decline to capture extreme fundamental value. Today, we are flipping the script and looking at the exact opposite approach, right side trading. If left side trading is about predicting the fundamental bottom, right side trading is about waiting for mathematical confirmation. This approach aligns perfectly with strategy 2 from our early philosophy lessons, trend trading. What exactly is right side trading? It means you are entering the market after an uptrend has already been confirmed. You are waiting for the momentum to shift in your favor. Yes, this means you are deliberately accepting a higher entry price. You will not catch the absolute bottom, but in exchange for that higher price, you receive a significantly higher probability of immediate upward continuation. You are paying a premium for certainty. So, what constitutes confirmation? Right side traders do not guess. They wait for clear technical and structural signals before committing a single dollar. We are looking for three main triggers. First, breakout of resistance. The price surges past a historical ceiling, like the neckline of a W bottom or heavy congestion zone, ideally with a massive expansion in trading volume. Second, reversal pattern confirmation. The completion of bullish candlestick structures, which we will cover in chapter 3, or broader structural patterns like cap and candles, which we will dive into deeply in chapter 4. Emotion-driven momentum. A short squeeze where institutional hearing rapidly drives the price upward. Like all strategies, right side trading has a specific risk profile. The biggest advantage is that you are swimming with the current. Because the trend is already established, your risk is strictly defined. You know exactly where your stop loss goes, usually right below the breakout level. The main disadvantage is dealing with false breakouts. You will frequently encounter stop trends, where the price breaks out, triggers your buy order, and immediately reverses, hitting your stop loss. If you trade in right side, you must be psychologically comfortable taking multiple small, calculated losses in a row until you catch the major wave. This brings us to the most dangerous trap for retail investors. I want to be perfectly clear. Right side buying is not the same as chasing. The line between a disciplined right side trade and the emotional mistake is entirely defined by your preparation. A disciplined right side trade involves strict math. The entry point, the position size, and the stop loss level are calculated before the trade is executed. If the breakout fails, the trader accepts the loss and exits decisively. Chasing is an emotional response to FOMO, the fear of missing out. The, the amateur sees a massive green candle and buys impulsively without checking resistance levels or having a stop loss plan. When the market returns, the chaser freezes, fights the trend, averages down randomly, and destroys their portfolio. To ensure you are trading and not chasing, you must master right side position sizing. If you are adding to an already profitable position on the way up, your new position size must never exceed your base position. This prevents your average cost basis from spiking and turning a winning trade into a loser on a normal pullback. If you are initializing a brand new position on a breakout, your stop loss is dictated by the chart structure because that structural distance varies from trade to trade. You must calibrate your position size accordingly. A strict quantitative rule is to size your position so that if your structural stop is hit, your loss never exceeds 1% to 2% of your total portfolio equity. Furthermore, your expected risk to reward ratio must be at least 1 to 1 and ideally 2 to 1. To summarize, left side trading is about accumulating value during a panic. Right side trading is about capturing momentum after confirmation. In our next video, we will put both of these strategies together and answer the final piece of the puzzle. Strategic profit taking and trading stops. Knowing when to buy is only half the battle. Knowing exactly when and how to sell is what actually builds wealth. Thank you for joining me in the Quant Lab, and I will see you in the next lecture.